as a family office managed to navigate this really shaky year, 2026, across tariff, war, all this stuff, AI. It's like the old playbooks of investing have been designed for a world that doesn't exist anymore. And we wanted to really have a conversation between family offices, VCs, and entrepreneurs to answer the question, how to allocate your portfolio across blue chips, bonds, stocks, alternative, crypto, private, and different stock exchanges really in 2026. And we've brought to this place probably some of the best people that we had in our network. And I think that discussion they've made was quite interesting. I mean, we had KKR, one of the largest private equity funds in the world, represented with Adam King here. We also had some of the largest European VC funds doing alternative investment with Daria and the World Fund, which have been a tremendous admirer for many, many years. And then we had some of these companies that are actually taking shape in the US as the new American dynamism and being played through those tariffs to relocate and reshore industrial facilities in the United States with Ben and his EV manufacturing facilities in California. I think this is a very important panel for any investors that decide to really allocate capital in 2026, and I think a few of the questions that I've been asking myself have been answered during that panel. I hope you will enjoy it.
All right, and for this panel, we are hosting a few of the most, I would say, big guns on this aircraft carrier. We have here some of the most prominent people that I've got to meet for the past year, really, and I'm going to introduce them to you. So we have here Daria. Daria and I goes way back, but she doesn't know it because it's a one-way relationship. I've been following her and the work that she's been doing on the World Fund for the past few years. It's one of the largest funds in Europe doing technology and frontier. Such an honor to have you joining us all the way from Munich, right? From Germany. We have so many nationalities here today. It's amazing. So thank you so much, Daria, for joining us. It's really an honor. I'm looking forward to hear what you guys are cooking for the World Fund. And then right here, we have Adam King from KKR. For those who are not familiar, if you know BlackRock is the guys that we talked about, right? KKR are the other big private equity guys. I think this is about $350 billion AUM or something around that. Yeah, I got a little bit more, okay, sorry. Adam here is one of the good guys. This is not the typical Wall Street, you know. We're talking about the person in all this ecosystem who is leading climate and of course investment. So thank you so much, Adam, to join us today. It's really a privilege to have institutions like yours to be joining us here, and we're looking forward to hear what you guys are doing with KKR and how that whole frontier excitement is actually tying up with your assets for the next decade. And then we wanted to have on this panel also some of the actual people quietly building things, right? And here you have Ben 𝗔𝗫, the CFO of one of the largest EV trucks manufacturing facility in the whole California, and probably one of the top largest one in the whole United States. He's got about 3,000 square meters of building machines, creating the future of that reindustrialization. We talk about the great American dynamism. Well, you got him on stage, and Ben, the last time I talked to him, he was just, you know, yeah, I got 100 million, and now he raised about 400 within 12 months. So this is one of the fastest growing company in the United States that you're seeing, and those guys are gearing up to be the next listed IPO. So yeah, we have such a great quality of panel here. I really want to call everyone who is talking on the back to come and sit up, because we really have such a great panel. I'm sure you guys will learn more by sitting here. Anyway, last but not least, I want to introduce my dear friend, Benjamin, which have been a friend of mine since Hong Kong, where I used to live, and he speaks fluent Chinese, by the way. Not only handsome, he's also very smart. And before that, we used to be together in France when he was the smartest kid in the room. And today, he leads his own company of consulting after been working with BCG for many, many years. And he's going to bring those very smart lenses of consulting person to try to analyze what's going on with this topic of today. Without further ado, I'll let you, Benjamin, take it over. Thank you.
Perfect. Thank you so much for your kind intro, Joan. And great to be here with such a distinguished panel today. So actually, we've talked about a lot of things today already. My first question is actually to the audience. So how many of you, raise of hands, are investors either professionally or personally? Just show of hands. All right, so most of you. Now, how many of you have changed your allocation of your portfolio based on recent shifts in the macro regime, be it geopolitical events or changes in supply chain considerations or tariffs, things like that? Raise of hand. All right. Well, I think all of you will find today's topic very interesting because we are going to talk about the 2026 portfolio and basically macro factors impacting how both LPs and GPs, as well as entrepreneurs, how they're thinking about allocating their portfolio. So my first question to our panel today is, so we're now, as I mentioned, in a new macro regime in terms of geopolitical instability, tariffs, raising defense spend, also the increased importance of energy security. So how does that environment change or not change how you think about allocating capital, and has it become harder to invest in climate?
Sure, I'm happy to start with this question. I think it's a very fair question. So at World Fund, we invest along into trillion dollars worth industries. It's energy, industry, and food and ag tech. And we believe that this is going to be completely rethought and redesigned. Regardless of how we call that. And we used to say, we're a climate tech fund, focus on these 3 industries. Now we say we focus on these 3 industries. And by the way, when we look for outlier companies, we use, financial analysis. We are a financially driven VC, but we also believe that decarbonization is one of the biggest growth drivers. So kind of, we do think a lot about the packaging, but our product remained the same, and all the way how we invest remained the same. And in our portfolio, you can see, we invested in IQM, which is one of the leading European quantum computers companies. Actually, also announced plans to IPO by the end of the season, before the summer. We also invest in recycling of batteries, and it was decarbonization, now it's critical materials tech, right? So for me, it's a lot of kind of narrative change, but given our thesis, we haven't really changed the core of our investing. But the storytelling is hard.
Great, thanks so much, Ben, and appreciate the opportunity to be here. Again, I'm Adam King from KKR. We're a multi-asset manager, really investing globally and across alternative asset classes. I think how you framed the question was a great way to kind of mention some of the kind of causes of the current macro environment. You're talking about increased geopolitical kind of rivalry and risk and messy energy transition, talking about sovereign countries having higher debt ratios. I think we also try not just to look at those causes, but what are the actual symptoms of that and how does that manifest at the kind of investing level. So to your point, change in macro regime, I think we're in a rate of lower growth. We're expecting to have higher interest rates for longer. I think there's increased regional diversification and kind of growth levels are going to really vary between regions more heavily, and there's going to be stickier inflation due to some of these causes. So how do we really think about investing behind this new regime? We're looking at a few key factors. I mean, really, we're looking at an increase in quality across the portfolio. We invest much later stage than many of the cool VCs in this room. We're typically, later pre-IPO or even doing buyout where we're owning the companies. But we think kind of a flight to quality might be necessary over the next couple years. We also think, trying to have asset-backed or kind of real asset-tied investments is super critical. It can help with inflation protection. It can help with risk mitigation. And I think when you zoom out, a lot of those themes are very interlinked and beneficial for climate investing, energy investing, digital infrastructure investing. So we don't view those as attractive themes just from a sustainability perspective or because of what they do to the planet. We view them as attractive themes because they're well in line with our overarching macro thesis. So I think when you really zoom out and how to take a long-term investing view, you're thinking over what's the kind of macro regime that we're in. Are we in low interest rate, kind of ZERP environment where everybody should be just deploying capital into SaaS over the 2010 landscape? Or have we kind of fundamentally shifted to a new regime where real assets, inflation linkage, domestic production, kind of high barriers to entry is what might be some of the keys to winning over the next 5-10 years? And what are sectors that align with that? We think energy, power, industrial manufacturing, and of course, like many have talked about today, data centers are areas that will be pretty key over the next few years.
So I'm not an investor, but as a founder or operator, there's a path of least resistance. And until your business is profitable, you kind of have to position your company and your pitch to something where there's capital that's being deployed. So I think having that optionality when you start your company and being able to lean into the previous administration and the IRA and all the climate dollars that were being deployed is what led investors to pursue that. Right now you have revenue in data centers and defense tech. It's either government spending or private spending that's going into that. And as a result, the investors are following those dollars and the revenue that will be generated by it. In our company, we're lucky in that because of vertical integration and the fact that we do so much in-house, we can adjust the business and follow the capital. So when we started, we were leaning into the IRA because we were making electric trucks. Today, we can leverage the IP making electric motors and turning those into generators or turning these electric trucks into defense drone vehicles. And that's what's helping us fundraise in this environment at higher valuations and bigger dollars. So keeping that optionality has been important for us.
Thank you. So you've talked a little bit about how the current macro situation is impacting how you're allocating capital. I'm curious how you think about how that same environment is affecting basically your portfolio management or how your value creation plan. So to what extent you're able to leverage sustainability or policies for your value creation and portfolio management.
Yeah. So look, we always, from day one, said we don't believe in green premium. We also don't believe in sovereignty premium, which is now, something we talk about in Europe a lot, because Europe is sandwiched a little bit between China and the US, right now. So, hence, our portfolio companies focus on building solutions for their respective industries, which are either better, faster, cheaper. Often it's cheaper for their customers. So I think we continue to support them to sell the value of their products, which was never, the sustainability itself. And I think there is a good example of a company which is Munich-based. They're called Planet A Foods. They're a lab. It's like a lab-grown coca substitute. So because of the climate change, in the last 2 years, the cocoa prices went up at like all years high and within the like 40 years. So they're an ingredient provider. They go to their customers and they don't sell the sustainability, marketing. They say, we are cheaper, like significantly cheaper at the same product quality parity, right? So we do continue to support them, move into like sell that and focus on the value of creation for the customer. At the same time, we do have a sustainability practice where our colleagues sit down with the founders and talk about, what are the sustainability goals, mostly like 1 to 2 for the year, which are going to drive your value creation for you specifically. Well, we don't want to bother them just for that because we are a climate tech fund, but we really want like our companies and founders to grow better and faster and more and have the longevity in that. And I think we continue to do so. And the feedback is always very positive. So I think like calming down, the situation, you're in shock, and I'm saying hey, what does it mean for us? And luckily, there is a lot of opportunity being created even by the war in Iran, right? Where again in Europe are reminded how exposed we are in our energy kind of sourcing, right? We already talked about it 2022 when the Ukraine wars happened. Then we it's a very good example how short-sighted the memory of humanity is right now, and now that gives an opportunity for startups to sell their product, to push their products. And I think I would say we see it as an opportunity and try to advise our startups to do the same.
I think you hit a lot of really great points right on the head. I'll really try and keep this to 3 main things. One, going on the back of what you said about sustainability, that is a value creation lever of ours. I think how we've repositioned that and focused on it in the past couple of years has changed a little bit, which I'll come back to. Second would be policy, helping companies with policy analysis, and then third will be geopolitics. And those aren't super novel themes in themselves, but I think, KKR with the level of resources, expertise, dedicated team, we have full dedicated teams of experts across each of those topics is really how we can differentiate ourselves as investors versus being a kind of single theme investor that one person is targeted to support the company across everything. So on the sustainability side, I'd say quickly 2 things that have become more relevant have been climate risk versus decarbonization. I think there's less value being put into decarbonization. It's not being priced in by other investors. I think we are seeing the ability to support downside protection and help mitigate risk within our portfolio companies as they think about climate risk, going back to the theme of this conference. And then I'd say, equity ownership within our companies has been a huge focus and topic across KKR. I think particularly in the US, you can tie it back to the macro theme of wealth inequality. You see a lot of normal day-to-day workers not having access to the type of wealth movement and equity that a lot of us might be able to get access to through the stock market or through private companies. How can we deliver that to employees of our companies and use that as a employee engagement tool, motivation tool, retention tool? Not really 2 typical themes within sustainability, but I'd say that's one big one. Geopolitics, obviously any company that's operating globally and internationally needs to have a geopolitics team and advice and advisory. We can support them with that as they look to expand internationally. I think the recent wars are great examples of how messed up and screwed up your supply chain can get really quickly if you have a bunch of suppliers in Russia or have a bunch of operations in the Middle East and went and built a bunch of offices in India and that stuff can change on a dime. So we support a lot with that. And then obviously policy, I think there's just a more volatile, fluctuating policy environment, and so startups, mid-sized companies that might not have the resources to fully analyze or have connections on the Hill and in state legislatures, the more we can help with that, the better, because taking advantage of policy and the kind of shifting winds is really critical until you get up to not just revenue and fundraising, but then to the point of profitability, which you brought up earlier.
So again, I'm not an investor, but I guess inside our company we have 500 people. We have maybe 10 people that are looking at other verticals to expand the business into, like so a defense vertical and energy generators and autonomy, where we get to leverage the IP that we have in-house and then go find customers for that. And so we're spending a small amount of our time on that, but it has a lot of benefits. Most of the company stays focused on the core business, which is a climate-related business and building hybrid and electric trucks to decarbonize last mile delivery. Yeah, that's what I would say on that.
Thank you. Maybe a follow-up question for Ben here. So Ben, you're at Harbinger. You're building one of SoCal's hardware unicorns with presence in data center generators, EVs, and defense. So, and that's in the middle of a context of, reshoring and tariffs, for example, on Chinese components, Chinese EV batteries. So how does that impact, how does that context impact both your supply chain strategy, but also your financing strategy?
So we are the world's most vertically integrated trucking company. We not only make our own batteries and our own transmission, our own motors, we make transmission, we make suspensions, make differentials, we make our own autonomy software. So we haven't been very affected by the tariffs. It makes our competitors' products more expensive, which is nice, but there's still supply chain there's still disruption to the supply chain. There are certain things that you can only get in China, and they're not what you think they are, like aluminum, large format aluminum casted parts, which are like 1 meter by 1 meter engine housings or battery pack housings. The only capacity globally that exists is in China. So that's one part that we haven't been able to get out of China. It's not a material part of our bill of material, but strategically, if the border closes, we have a problem because we can't keep making battery packs and motors. So I've actually been flying to the Middle East before the war to try to convince people over there to start making those parts. The Middle East has very cheap power, some of the largest aluminum smelting plants in the world, and very cheap capital, and making this sort of stuff is capital, power, and aluminum. I haven't succeeded, but I'm like going around the world trying to get somebody to do it. KKR should do it. Yeah. Otherwise, we're not super affected, thankfully, because of vertical integration and the fact that we're doing all this stuff onshore. The tariffs have allowed me to beat some of the Chinese OEMs in the battery space now. So we just won a $100 million PO from Airstream. They make travel trailers, and they had a Chinese OEM that supplied them with batteries for stationary storage, and we were able to beat them on price and performance. So that's a benefit. In general, I would say tariffs are bad, though. They make companies lazy, and you can't compete on a global scale. You can only compete inside of your own country, and that's not ideal.
Thank you. You mentioned Airstream, and there's actually, I think, an Airstream somewhere at the back of this boat. All right, so a question now for the whole panel again. What are you seeing in terms of demands from your LPs, and are there any variations by geography? So for example, are you having to focus more on certain types of investments or certain type of messaging in certain geographies of the world versus others?
Yeah, I think, so World Fund is majorly focused on European deep tech, and almost all of our LPs are from Europe. So geo-wise, that doesn't affect us. We have quite a balanced portfolio of LPs in terms of where they come from, but many institutional LPs, I think their expectations are outlier returns first, and then more entrepreneurial capital we have also care for climate. So I think as long as we can prove and also show that we're on it, we have the trajectory to invest in where we believe the fund is going to be returned. And as I said, if it's not climate, we talk about energy, energy security, and we talk about food and ag, food security, we talk about resilience, European, sovereignty, all of that. In the end of the day, all of these technologies we look into are the groundbreaking technologies for the next era of frontier tech, right? So for that, we saw or still see quite a strong support from our LPs. But as I said, the narrative is the bitch. So we did have to sit down and kind of discuss, like, okay, so how do we make them feel comfortable?
Yeah, I mean, I don't think we've ever really been big believers in the green premium, but I think especially right now, you can pretty definitively put that one to bed and put it in its grave. I think there was probably a little optimistic period there where there was assumptions around people being willing to buy things that might be less affordable or less reliable because of the sustainability angle of it. And I think a lot of what we're looking at, particularly in the power space, needs to have all three legs of that stool, right? It needs to be reliable, and there are issues with that with kind of current renewable energy development, but there's also a lot of great reliable renewable energy as you pair solar and storage, things like that. It needs to be affordable. I think there's such a focus on cost of affordability right now in the United States, and with broadly, I think we're going to have a bit of an energy crunch everywhere in the world for a meaningful period of time, not just if this Iran deal gets opened up. And then sustainable, I think that's more than just emissions sustainability, but local community support is increasingly being a big issue for any new power development, for data center development. You will, I guarantee, see a ton of headlines about that in the next 12 months, about data centers or new power plants getting shut down because the local community says, hell no, we don't want that. And so I think the big picture is, like, historically there may have been an over-reliance on the sustainability lens, and let's move it back towards an equal weighting or maybe even an increased weighting on the affordability of those three legs of the stool.
We have no green premium, so our trucks are the same price as diesel trucks without any incentives. That's why we sold $100 million of them last year in our first year. We grabbed 85% market share in electric vehicles in 1 year. Generators is an area where we're stepping into because there's so much demand for power. But we're only focused on the US because it's expensive to go to other countries. And so right now there's plenty of market here, and we don't have the capital to think about other markets.
Thank you. Second to last question before we open it up to our audience. So do any of you currently do business with the Middle East or raise funds or invest in the Middle East? And if so, how is the current situation affecting your position there?
Yeah, we do, and we have some operations there. I'd say first and foremost, our focus is on the safety and kind of comfort of our staff there, any of our companies there. We have 3 different offices in the Middle East, and I think the way that KKR has been able to support our employee and family there has been pretty awesome. But I think, we view that as an attractive long-term space over the long run. I don't think the short-term, kind of changes in some of these markets like the UAE or Saudi change what has been a multi-decade economic shift in diversification. So we'll continue to be bullish on that market, but short term, obviously super cautious and just focused on supporting communities where we can.
We have a number of investors. I think stopped and froze. I was going on a monthly basis before the war. I stopped going because of everything that's going on, but activity has picked back up pretty fast over the past 2 or 3 weeks.
Thank you. All right, last question, and I'll ask our distinguished panelists to answer briefly in 30 seconds or less. So given the current macro situation, what do you absolutely want to have and need to have in your portfolio in 2026, and what should you avoid this year? 30 seconds or less. Thank you.
I would say what you should have. You should have our portfolio, our fantastic 25 companies. And we are raising for a fund too. So in case you're interested, I'm here to talk about it.
Yeah, I think yeah, you need a lot of KKR in your portfolio is the advertising answer, along with exposure to broad geographic regions. I'd say you got to have digital infrastructure in your portfolio. You've got to have power in your portfolio, and you've got to avoid companies that rely on green premiums. I'd say is things to avoid.
In my personal portfolio, the last thing I added is Robinhood has a fund that is publicly traded and gives you access to late-stage venture, pre-IPO companies, and somehow they figured out a way to do that. That's the last thing that I added.
All right, thank you so much, everyone. I know that time is up. Any questions from our audience before we wrap this up? All right, I think we have one question, and that will be it for today.
Yeah, I think you've alluded to the...
we can't hear you.
Oh, I'm sorry. Can you hear me now? Is it louder?
Sort of.
Yeah, what would you like me to do?
Just keep talking.
Yeah. Yeah, you've alluded to the geopolitical issues regarding sustainability. And I think that, regardless of whatever side you're on, the data is still lacking. It's still pretty scarce regarding CO2 impact, whatever you want to describe it as, in the environment. And I wanted the panel to talk about that a little bit. Are we going to see more data? I mean, the fact that you're zero CO2 or low CO2, that's helpful, but do you think that we will see data that shows the air getting cleaner, or areas where you see these strategies where you can see material and identifiable proof that these technologies are working? Because, by the way, I'm an advocate. I'm on the sustainability team, but I know that we're seriously lacking in data, and I'd like your thoughts. Are we going to see any data in the near future, in your opinion?
So just to make sure, you're not talking about the geopolitical situation in general. You're talking about are there going to be tools to measure the actual impact on air quality? Exactly.
Okay. I mean, because the argument is around the world. It's not just here.
Okay. So very briefly, if anyone wants to answer that.
Maybe very briefly, we do have a lot of data, and we also have data from the best experiment ever, which is called lockdown COVID, over several years. What happens when the world shuts down, and what an impact on the CO2 it is, and on then health issues, air quality, all of this. And I think it's quite showing that there is a very strong positive impact. And there is another example maybe of Paris in France. They proactively shut down the transportation, car transportation in many spaces, and now you can see the air quality went increased very strongly in all of the analysis they run all the time.
Okay, thank you so much, everyone. I think this wraps it up for today.